Is the Phoenix housing market headed for a boom or a bust? Today, you're going to hear my Phoenix housing market predictions for 2021. Plus, I'm going to help you figure out whether or not now is the time to buy your place or whether you should wait a little while before you make that move. So in order to make any kind of good financial decision, we need some facts, right? So what we're going to do is we're going to take a look at the Cromford Report, which has been compiling real estate data for decades. So let's take a look at our slides and see what the data tells us. Okay, so this first slide is the Cromford Demand versus Supply Index. And you can see there is a red and a green line, and they come apart and they come back together. And here's what this is telling us. First of all, we've got this line right here, this faint yellow line that tells us this is where we have a balanced market. Anything above that or below that tells us that we're out of balance. Up here where the market is, where this red line is going up really high, that tells us that the supply is really high, and over here this green line tells us that the demand is really low. So in this particular case right here, back in 2007 through 2008, that means we were way overbuilt and we were way overpriced, and people knew it and they weren't going to buy anything. And then prices started to slide back down and demand started to build back up, and so people started to buy again. And it wasn't until around 2013 and 14 where we initiated a first-time home buyer incentive that the market started to reach what we called a balanced market. And since then, the market has kind of drifted along in a balanced place until we reached 2018 when demand started to go up through the roof again. So right now, demand is very high. Right now, supply is extremely low. As we look further into the other slides, we're going to see just how high demand is and how low the supply is. Let's take a closer look. This is the Cromford Market Index. This is a single value that indicates the balance of the residential resale market. Values below 100 indicate market in favor of buyers. Anything over 100 indicates that it's in favor of the sellers. And of course, 100 is what we call a balanced market. So you can see in 2005, we were definitely out of balance, and it took about 8 months for it to come down to what we call a balanced market. Now in 2020, you can see the trajectory of this line shows that we are still headed in an upward momentum, and we're probably not going to be turning the corner for some time. So if things had started to crest and move downward, you could say that we probably have at least 8 months to go. So I think it's safe to say, looking at this, that we've got at least a year before we're going to come down to a balanced market and it's going to favor the sellers. So the question is, does that mean you should wait a year or so to buy? I think the future slides are going to help us figure that out. This slide here is all the listings that are on the market that have gone under contract, and the two different colored lines represent 2 different years. This line here represents 2019. This line up here represents 2020. So in 2019, we had about 9,500 homes that were on the market under contract. Today, we have about 12,300 homes that are listed and under contract. That's an increase of over 30%. So that's a big difference, and that tells us that there is a strong demand in the marketplace, and the buyers are out there eating up all the houses that we put on the market. Now this next slide shows us the month's worth of supply. Now let me tell you that a normal amount of supply is 4 to 6 months. Back in 2019 of November, we had about 2.5 months worth of supply on the market. So it was still about half of normal. Today, we have less than 1 month's worth of supply. That means if we stopped putting any new homes on the market, it would take less than a month to sell it all. So I hope this is beginning to build a picture for you. It definitely shows me where the market is headed, and I think you can see too. This little chart shows us active listings per week on the market, and each of these lines represents a different era. This is 2020, this is 2019, and we can see that in 2020 we have about 8,000 active listings on the market compared to 13,500 back in 2019, 1 year ago today. So that is a big drop in the number of listings on the market. That's about a 38% difference in the number of active listings on the market, meaning you have 38% less homes to pick from than you would have had this same time last year. So does that tell us that it's a little bit harder to find a house right now? Yeah, it does. It's similar to walking into the grocery store and only seeing a dozen loaves of bread on the shelf, whereas normally there's hundreds of loaves of bread. Right now, there's just a lot less to pick from. Now, this chart shows us the average number of days it takes to close a house. So this is 54 days back in November 2019, and today it's 33. So this means that the house goes on the market, somebody comes along and decides to buy it, they write a contract, seller accepts it, and it's taking around 54 days to get it on the market and closed. Now it's only taking 33 days. That means the house goes on the market day 1 through 3 and actually ends up closing about 33 days later. So good houses only sit on the market for 1 or 2 or 3 days before they actually go under contract, and then they take about 30 to 40 days to close. Now, a lot of people are saying, hey, I don't want anything to do with this crazy market. I'm out of here. I'm just going to lease for a while. Well, you can do that, but guess what's going to happen to you? You're going to pay a lot more money to lease a place today than you did a year ago. Here's why. You can see a year ago that the price per square foot to lease a place was about 93 cents, and today it's about $1.18. So that's an increase of 21% more you're going to pay for rent than you would have this time last year. And based on the trajectory, it doesn't look like that is going to change anytime soon. Rents are going to be higher this time next year. So the rental market isn't doing you any favors. It's making it more difficult to save the money necessary to buy a house. In fact, in a lot of cases, the rents are as high or higher than a mortgage payment. Now, this slide is interesting. It's showing us the average number of closings per month above the list price. So normal is going to be right around 15%. So let's say about 15% of the homes that are on the market are going to sell above the listed price. And last year this time, we had about 19% of the homes that sold above list price. Today, it's 36% of them. So if you've got a really good house and it's priced at about $390, chances are really high that it's going to close closer to $400 or $405. You're just going to have to pay more in order to be able to compete. But does that even make sense? Are people losing their frickin' minds? Let's take a look and see where you would be at payment-wise if you were to do this. But first, I want to take a look at the contract ratio, just to show you what's going on in the market with the inventory that we do have available for sale. Now, these are various areas in town, and what I'm showing you here is that over here in the West Valley, in the Goodyear area, in the Estrella area, in the Avondale area, we're seeing about 2 times as many homes under contract as there are available. So if there are 40 homes available for sale, there are 80 homes under contract. In Youngstown, it's even worse. It's 7 times. So if we have 10 homes available for sale, we have 70 homes under contract. That's absolute insanity. Over here in another part of the West Valley, 5 times the number of homes under contract that are available. And you can see these various numbers all over town where really these numbers are just absolutely insane, off the charts. But in order to compete to get a house in these areas, you really have to go after it. This chart shows us the prices in 2019 versus prices today. You can see that in 2019 in November, prices were around $360,000. Today, they're around $430,000. So why would it even make any kind of sense to buy a house today? Let's take a look at what your payment would be today versus 1 year ago. So if you were to buy a house a year ago for $360,000 and you were to get a 30-year note at 3.7%, you'd be getting an A-plus loan. That would be a great interest rate 1 year ago. Your payment would have been around $1,325 per month. Now today, if you were to pay $430,000 for that same house, you'd be getting it on a 30-year note at about 2.5% interest, and your payment would be around $1,359, a difference of about $34 per month. So as you can see, homes are definitely affordable right now, even though the prices are a little bit higher. And I can tell you that recently I added up the interest rates over the last 50 years. Every year is averaged out by Freddie Mac on their website, and when I add them all together and divide them by the last 50 years, it comes up to an average interest rate of about 8.1%. So if that's average, is 2.5% interest good? Yeah, it's really good. And is it conceivable that we could be seeing interest rates close to 6% sometime soon? Absolutely it is. So if we bought that same $430,000 house at 6% interest rate, you'd be looking at a payment of about $2,000 per month, which is right around $700 a month more than you'd be able to get it today at this 2.5% interest rate. So interest rates are a big deal, and we're probably never going to see interest rates like this again in our lifetime, based on the averages. So I hope this video gave you insight into what's going on with the market and where the market is headed. In the meantime, check out my home buyer guide series right here and my next video here. And again, thanks for watching this video, and I'll see you on the next one. See ya.